All right, folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. I'm back with my janky cardboard subscribe sign and my cheap vinyl background to talk about one of my favorite stocks, SoFi. Its performance in the last year has definitely not made me very happy, and it's not made it one of my favorite stocks because of that. It's really about future value of SoFi. Now, we've seen a little bit of a run-up in SoFi price here in the last couple of months. And a lot of that, I think, really has to do with the fact that there are a lot of new contributors out there when it comes to content on SoFi. A lot of this is being driven by Reddit and YouTube. There are quite a few financial channels that are out there that once covered a variety of different stocks, and lately they seem to have shifted to a SoFi-only type of content deal. There's like 4 or 5 guys out there in particular that I've taken a look at recently. And look, this isn't necessarily a bad thing, but it can lead to a fire hose of information on this subject that really only takes in one perspective. Now, I have never made it a secret that I hold quite a few shares of SoFi, and I definitely fall on the bullish side when it comes to this stock. And as a professional investor with a distressingly long career, I tend to be hyper realistic about what I can expect in terms of performance. So I typically invest about 70% or more of my investable assets in index funds, and I only invest roughly 30% in individual stocks. So if I'm going to invest in individual stocks, I expect the long-term performance or long-term returns to be greater than the performance of the S&P 500, because that is kind of my measuring stick for the rest of my portfolio. And when I say my long-term strategy here, my theoretical holding period is forever, and I rarely sell a stock before that 7 to 10 year time frame. Ideally, what I want a stock to do is to grow to an amount where I can sell way out of the money calls that are not likely to be exercised, that's going to support my lifestyle. That's been a strategy that's worked for me for the last 6 years that I've built up my portfolio. Well, I've been investing for a lot longer than that, but the last 6 years or so, I have stopped working full time, and I just do a variety of things to support myself. So I'm self-employed, and I live off of the income gained from my portfolio as well. So obviously, if I own more than 10,000 shares of SoFi, and it is sort of a part of that 30% of my holdings that is supposed to support my lifestyle here, that is in individual stocks, and I'm sitting on a substantial loss at this point without any plans on selling, I have expectations that this stock is going to perform very, very well in the future. Even so, it doesn't have me all too excited about the recent run-up in stock price. I think it can be very, very fragile at this point. And like, don't get me wrong, I've enjoyed it, but I'm waiting for the SoFi hype to be backed by financial results. And in the next couple of quarters, we're probably going to start seeing that happen. And I'm really looking forward to it, as the last year has been absolutely brutal. So the next quarter's results are coming out on January 30th. And this is a little bit of a preview, not necessarily of the quarterly results, because I don't know what they're going to be, but taking a look at what SoFi is going to be putting together this year and looking forward to what's coming in further years. So SoFi, as you guys know, isn't playing a simple game of checkers when it comes to business. What they're doing is really three-dimensional chess, and it's going to take some time for their advanced strategies to build the financial empire that they're dreaming of. Now, when I read through a lot of traditional financial media, I see a picture of SoFi that is actually pretty incomplete. So a big question in my mind and in the minds of financial writers is how to assign a future value to the company. Now, there are arguments to be made that SoFi should be valued like a bank. In my opinion, this is a radically incomplete view of the company, and views that are based on that valuation really aren't valuable or valid, right? So there are a couple of other instances where I do this to a company where I break it down to their biggest revenue stream, what's driving their business. I say, this is how you value the company. And there are some famous companies out there that I do that to, that I dismiss other parts of their strategy because it's not clear that that's actually going to happen. So in this case, it's not something that I do with SoFi because it focuses exclusively and excessively on the consumer side of their business, which, to be honest, for right now is driving the majority of their revenue. but is by no means an objective measure of the future value of the company, and by no means is that consumer side also underperforming. SoFi is still, and always has been, simply a growth story. Their growth has been unstoppable since the day they were founded, and no math or financial wizardry is likely to convince you otherwise if you actually take the time to read through their quarterly reports. Now, SoFi has made darn near a miraculous pivot on lending products in the last couple of years. Origination of loans has rather rapidly shifted from student loan refinancing to personal loans, with the personal loan business as of last quarter likely being higher than any previous 3-month period of student loans in the past. That might not be true, but I have to go back a couple years to check it, and I'm just too lazy to do it. So SoFi has just now started to also rake in deposits from other financial institutions, driven in part by stellar rates on high yield savings account, and of course the bank charter, which most fintechs don't have. This is driving new member growth to the tune of 60% per quarter, and I really don't see that slowing down when we see the next quarterly report on the 30th. This is also driving interest income and, most importantly, cross sales of other SoFi products. Which brings us to why you can't simply look at SoFi as being just a bank, because its primary income right now is from loan origination. Because it isn't just a bank, it is becoming a one-stop solution for all the financial needs of a consumer by adding financial services to their banking platform, which has always been understood as a portion of their strategy. Adding financial services like brokerage, recently introduced options trading, managed accounts, ETFs, automatic investing, and financial and estate planning, all that adds to the bottom line. And in the last quarter, financial products actually grew at a pace of 4.6 to 1 when compared to lending products. So financial products are actually sort of taking over the space that used to provide the most revenue to SoFi. And I almost forgot to mention something that's coming out in terms of financial services. It is a dead simple product. It's going to be introduced this year. It's likely going to add to the war chest of cash that SoFi is sitting on, and it's going to be used to further offer and fund loan originations. So SoFi already offers brokered CDs, which are not the same thing as a CD issued by a bank. SoFi has yet to introduce these, but they're likely to do so in the next year, and really likely to do so in the next 6 months. So why is this important? Because unlike brokered CDs, which you issue through a brokerage account or buy them on the open market, SoFi in that case is paid a commission to match a buyer with a seller of a brokered CD. SoFi CDs, bank issued CDs, will be used to boost the deposit base of SoFi Bank, which can then be used to further fund lending operations, which of course leads to more revenues. Look for this to be introduced before the end of the student loan moratorium on June 30th, as SoFi looks to build up that war chest to satisfy what is likely to be a rush of refinancing once payments resume on student loans. CDs are a dead simple product, folks. I can't really stress, though, how important they're going to be now that interest rates are higher and banks are once again going to be competing for deposits on the basis of deposit rates and services. For the last 15 years, there hasn't been much of a reason to switch banks simply based on rate difference. I mean, do you really want to go through all that inconvenience for an extra 0.1% yield? Well, all of that has changed now that the Fed has seen fit to jack up short-term rates to what will probably be north of 5% by the end of the year. So, all right, guys, if you watch my live streams, then I get a little bit off track sometimes, which is what I just did. So let's circle back to SoFi's strategy, and I want to talk about the most overlooked portion of this strategy. It used to be a tripart strategy of using 3 primary business segments to drive a product referral flywheel, much like Amazon, and it consisted of lending, financial services, and technology, with technology being the last thing added. It really needs to be updated at this point to be banking, financial services, and technology. Banking is, of course, more encompassing than simply lending and more lucrative, and the approval of the SoFi Bank Charter has made that a reality for them and will begin immediately to be reflected in earnings, especially considering the growth in bank deposits over the last 2 quarters. The business segment that I really haven't talked about at all, though, is really going to be the technology segment. And I think that is overlooked by the vast majority of financial writers and analysts when it comes to looking at what a future value for SoFi stock looks like. I think that this has enormous potential, and I even suspect that in 5 years, revenues from the technology sector of SoFi are going to surpass revenues from banking and financial services combined. Oh yeah, I said it. SoFi has made 2 acquisitions in the last couple of years that are going to be the backbone of the company's strategy of basically becoming the Amazon Web Services of the financial world. And I'm talking about the Technisys and Galileo acquisitions. These companies are part of a multi-year strategy for SoFi to not only become the one-stop financial app for consumers, but to become the one-stop solution for fintech companies who want to start selling products to customers without the expense of reinventing the wheel. What do I mean by that? Essentially, with SoFi seeking to become the Amazon Web Services for fintech, let's look at it this way. Let's say you're a startup company or even a large legacy bank with your antiquated COBOL systems and mainframes from the 1970s, and you want to start participating in the digitized modern financial world. You no longer need a very expensive army of coders to develop your own apps. You don't need to design your own database architecture. You don't need the expense and hassle of designing your own security protocols. And you don't need an overpaid army of compliance personnel. You don't need to have a separate arrangement for a payment provider. Heck, you don't even really need to design most of your own products because somebody else has probably already had that original idea before you did. All you need to do as a provider of financial products and services is to concentrate on appealing to customers and plugging into the SoFi API, in other words, the SoFi financial backbone, and get started making money. You won't have the expense and effort of managing a full technology stack in-house. SoFi is going to save startups and existing financial companies tens of millions of dollars and become that one-stop solution for businesses when it comes to financial modernization. Say you want to design a cyber banking platform that provides credit card services that's customizable and has like buy now and pay later options. They have something like easy direct deposit switching, lending options from 50 different banks, payments and transfer options, all to manage your business. Done. You could hire a developer to design something that looks like a unique app over the course of a weekend and probably be doing business before the ink dries on the contract without the millions and millions of dollars that you would need to develop apps. All right, so maybe before the ink dries is an exaggeration, but Technisys actually estimates that many companies will be able to begin doing business in as little as 3 months. Current evolution times for a fintech company are a lot longer than that. SoFi itself was founded in 2011 and a year later introduced its first and only product, which was student loans funded by alumni. The SoFi business-to-business approach offers a much quicker time to market for new ideas, and it's going to cut out a lot of the cost. And these companies are going to be able to configure, reconfigure, and offer new products and services in minutes, not months. So think about it. Fintech is likely going the way of e-commerce. Today, if you want to engage in e-commerce, you pretty much have to go to Amazon Web Services. I think they have something like 25% of market share at this point. It may be a little bit lower, a little bit higher than that, but essentially it's become a utility company for e-commerce. If you are engaged in e-commerce, you may already be a client of Amazon Web Services without even realizing it. If you have a Shopify store, Shopify, for example, is a client of Amazon Web Services, and all of their products and services are offered through it. So just like AWS, SoFi through Technisys and Galileo is a cloud-enabled platform that's going to provide scalability, server, storage, networking, security protocols, and integration into the world of digital finance. Beyond that, the platform is going to provide the ability to create and refine financial products and services dynamically based on customer needs and behaviors through the software that Technisys and Galileo offer. And I think Technisys calls their product design software the product factory. But perhaps most importantly, and the most lucrative part of this strategy for SoFi is going to be the opportunity for SoFi to become a sponsor bank of fintechs So the vast majority of these clients will not have a bank charter and they will be forced to partner with someone. So why not make that partnership as frictionless as possible and partner with SoFi, the technology platform provider, do that also on the bank side. I think that this is probably one of the most overlooked aspects of the product flywheel because it's not on there actually, it's sort of implied. When it comes to putting a value on future shares, that's what I think the most overlooked aspect is. And it will likely, at some point in the future, actually be the largest driver of both revenues and profits for SoFi. So I'm definitely looking at the quarterly results coming out on the 30th. I think they're going to be, at worst, not as bad as we expected. But the reality is that when I'm looking at Anthony Noto's share purchases in December, he probably has knowledge that we don't. Let me say probably. He actually has knowledge that we don't. He did a very large purchase of SoFi shares in the $5 million range, and I think that that's probably, the reasons are probably going to be reflected in the quarterly report coming out on the 30th. Don't get too excited about that, though. Still be a little bit cautious here. And just remember, guys, this is only my opinion. I don't have any inside knowledge. This is not a recommendation to buy, sell, or hold any security. You have to make that decision on your own. But I hope you enjoyed this video. Please like and subscribe, and I'll see you guys next time.